Good morning and welcome to today's edition of the London Session Open. Sorry for starting later than usual today. Had some issues this morning. And sorry about that. We're usually live around 9:10 a.m. and not 9:35 a.m. I'm going to provide you guys with a quick update on the markets, euro dollar, Bitcoin, gold, crude oil, and the DAX, and also talk a bit about the Federal Reserve, of course, see what happened. I see Mauricio in the chat box. Good morning to you, sir. Representing Italy here. If you are if you're watching this, don't forget to say hello. And if you're watching the recording, don't forget to hit the like button. Just click up here. A new page loads on YouTube, and just smash that like button here. Really important. Okay, guys, I hope you're having a good day so far. And let's begin. So we're gonna begin with the dollar index today. So this is the dollar index, and we had the beginning of a decline in the dollar index here on the 20th. That's the same day as well. The euro took out 1750, and we pushed down lower, and we activated this head and shoulders. Not sure if it's sort of, it looks like head and shoulders, head, left, right shoulder. And as long as we trade below this candle, we should technically be bearish. But what you can see here, the market just spiked upwards and actually traded above that candle and hasn't really reversed yet. So unfortunately, it looks like a failed head and shoulders. It spiked above. It might come back, but it suggests to me that we could potentially see the dollar looking to sort of push back into the middle of the range, and unfortunately starting to become trading sideways again. What happened yesterday is that the Federal Reserve stuck to its guns, which is they will continue to increase interest rates. I think the biggest change that you probably already figured out is that they removed the word accommodative, which is a word they were using to in essence tell us that interest rates are low. Removing that little statement suggests now that the interest rates are probably starting to have an effect on the economy, and they do anticipate the economy sort of interest rates to not necessarily be increased much more. It's a bit tricky interpretation. If you look at my Twitter yesterday, I did share some interesting, I think at least interesting. So this is the projections. So they anticipate real GDP to increase by 3.1% this year and 2.5% next year. Long run average is 1.8. Inflation anticipated to be around its long-term average at 2.1 and then 2%. Core inflation as well at 2% and 2.1. So don't actually anticipate, and as well the unemployment rate should actually improve a little bit. But they don't actually anticipate the economy to change. But if you look here in the bottom, you see it goes from 2.4 to 3.1. So they do anticipate to increase interest rates further. So these are projections that they have. So I'm guessing that the economy is doing really, really well, and they're going to increase interest rates, and when they increase the interest rates, that's when we're going to have these readings. So at the same time, if we're not close to a real GDP change of 2.5, well, the unemployment rate is not as good as 3.5, and inflation is lower than this, then they might not increase interest rates. On the other hand, if it goes above, so inflation ticking up, which is a high risk that might happen going forward, especially with the unemployment rate below its longer run average, then maybe it'll increase more. So nothing has necessarily changed, but they are telling us that interest rates they're not accommodative any longer, they're not low. So it could be the end of the beginning, but it's not necessarily sort of the beginning of looking to cut interest rates. I wouldn't say so. And Mr. Powell did what he does good, and he is very calm, and he's very sort of bland and not bland, but he does his job well. He communicates what the bank wants to do without actually disrupting things in a major way. Now, it's a bit tricky to interpret it like sort of exactly what happened, but trading wise and technically, we can clearly see here that the dollar is gaining a bit today, and might technically continue to gain further. That has implications for the euro dollar outlook. Now, technically, on the daily, the price traded below the September 24th low, and that was a rejection of the short-term trend, and we definitely capped, as you can see here. No, we have not traded below the daily low of the 20th, and so I suspect that as long as trade above this level, this market might push to the upside. However, though, most of the time when you have a bullish break like this, you will usually see the market go up, go down, and then upwards. You don't see this hesitation you're seeing here. So I'm careful, and I suspect really that it would probably be better for us to take a step back and see what happens over the next few days. I'm happy to remain bullish, and obviously longer term traders that have no issues and they have a strong view on this going upwards, there's nothing wrong with buying at 117 with stops just below 116.68. But for me and my liking, I think I see this as weakness, and it's not like a risk I really want to take. So I'm watching this, and I'm seeing, okay, we're creating lower and lower highs, and I think as a minimum, I think we need to take out maybe 17.56. So I think that this could go probably upwards and then probably lower, and then we'll see if it stays above this level. So it just does something like this. So if it goes up and then down, and then we have the high, and then we take out the high, then that's fine. Alternatively, the market just does like this, upwards and then down, and then look to buy here again on that pullback and upwards. So those are the two scenarios I have for you here right now. Big picture, it remains bullish. Again, as I said, there's nothing wrong. You have a low here, so maybe we should create a low here. But I'm not very confident in that outlook. And if we take out that September 20th low, then we're probably gonna initially trade maybe down to 16.20-ish on the break to these levels. Let's focus on the dollar yen today. So this is the dollar yen, and what's interesting is that the dollar yen pulled back a bit. Stock markets as well pulled back, and the S&P 500 setup I've been talking with you guys over the last few days unfortunately got stopped out. Technically here, there's nothing wrong with this market. You still have head, I think this is head left, right shoulder-ish. Actually, yeah. And then we have this target to the upside here. And then we have, if you look at it from a long-term perspective, especially if you look at it from a weekly, then we have this massive triangle that we just breached, and I suspect we can head to the upside. To trade this massive triangle, though, I want to see a break to 114.50-ish. But here, even in the short term, we're still dealing with an uptrend. Now here, I suspect this can go upwards and then probably a little bit lower. I think we have a bit of a hangover from the rate meeting, and you could potentially see a bit of risk off. In other words, a bit of yen gaining. But I suspect maybe down here, technically already from 112.45, but maybe from a little bit lower would be better, maybe 112.20. I suspect traders might look to rebuild positions here and just be bullish by 111.62. And then you have my preference, or my preferred setup, which is actually a break to the July high. Take out that July high, and you take out this level, then most likely we'll head higher. I'm not sure what happened with all my levels, but at that point, probably first stop would be 113.77, followed by this high here, and this is the most interesting high, 114.48. 150. Take that level out, and we will leave all this will be left behind, and probably it will open up for a strong rally towards this level up here, which is 118.68. So this could be a very good potential move, and so it'll be maybe the trade for the fourth quarter. What else? Let's talk about the gold prices. These are, as I put in my article yesterday as well, this is probably the best way, I think, to exploit dollar strength. The euro technically could still move upwards, so there's no guarantee that we're indeed gonna be stopped out. Technically, again, as long as you're about the September 20 low, we should be okay. So I don't want to be, shorting euro dollar. Rather, here it could be better shorting gold and buying dollars here. Why? Because we're dealing with a nice sideways range, and these are my favorite setups, breakout out of these sort of ranges. So keep an eye on this. A break to the September 11th low can take price potentially down to the August low. What we want to see, if we break, we want to see a break and then a close below the level, and then of course afterwards you have a bit of a bounce, and then hopefully just further weakness. Stock markets, actually let's take a look at crude. So this is West Texas, and we talked about this yesterday, and we talked about this for quite some time actually. I said a break up to this high could lift things. Market moved upwards, then it moved downwards, and it tested that breakout. I think now we can reduce the trend defining level from 71.12 to just below yesterday's low, and that level is the 71.39 level. So if anybody did buy here, the risk reward ratio now will be very, very low, and that's a great thing. We always want to try to do that, reduce the stop loss as much as possible, because then if it doesn't work out, it's not going to be in the world, and if it does work out, it's going to be fine. It's going to be good actually. I still think we can go upwards to the high as we pretty much did here in the short term, but then in the long run, I think we can take to 74.67, and then you have all these highs here, triangle objective target and percentage objective target up here. Here's the S&P. And the S&P unfortunately got stopped out. If you were trading this, that is. The view got stopped out. I wasn't actually trading this directly myself. Now what's interesting here is that we had that break to the upside. If one would have entered at 29.17 or 29.18, that would be good. Nice rally, and then unfortunately all the way back down. And we traded below the September 20th low. Sorry, I'll take this back. This was the tightened level, so the initial stop loss here, this could have been reduced to this level here, because it's nothing nice, when you have a nice profit and then you lose the whole lot. So here we would have been stopped out if you were, I would have been stopped out if I was actually holding this long here from 29.18, and then here, this is technically sort of the actual trend defining level to some extent. Let's just actually highlight that. But this is a big warning sign. Usually when you almost get stopped out like this, you will usually get stopped out. Sometimes you won't, of course. Now, I wouldn't be aggressively buying here right now in this market. We're still dealing with this downtrend, and we could potentially break that, and when that happens, I think we should be okay. In the big picture, we are dealing with a big picture uptrend without a doubt, and eventually, and traditionally, by the way, September, October, even August tends to be bad months for stocks. So we will have some sort of correction at one point, and I'm not sure how deep that's going to be, but if we fall back for 2%, which is actually nothing, maybe down to the September 18th low, I think this is where probably all of these bargain hunters is going to step in. And then of course, if we have those dramatic declines, and if we do revisit something like 22,800, then I think definitely people are going to look to get involved again. That would be from the high, there will be a nice decline of about 5%, which is, again, is technically nothing. 5% is nothing really. But I think down here, I think traders would, the real bargain hunters, I think they would step in and buy all these corporations that are doing good, but are now slightly lower prices. German DAX is moving downwards. This is a daily chart. As you know, over the last few days I said, probably it's going to roll over here and move slightly lower. I'm still sticking to that view because we're dealing with this overall downtrend. So probably lower, and then we'll see. We'll see if it just goes a little bit lower and then breaks upwards, so whatever it does. And I think the only thing we're missing is Bitcoin and the cryptos. So this is Bitcoin, and it's very, very boring, and there's not much to do here. There is some benefits though. You can see here, right? Trading sideways. When you have that break, it finally goes a bit choppy. It goes down, up, and then an inverse head and shoulders, head, left, right shoulder, and then you have that move. So right now it's a bit boring. It's boring not only in the short term, but in the big picture. But when we break, maybe upwards, maybe downwards, we're probably going to have some very good moves here. And so that's going to be interesting whenever that happens. Right now, though, it's very boring. I think the best thing is just keep an eye on it, put some alerts on it, and you get notifications when things happen. A break to 5,786 takes price lower. I think it's a little bit too early, but first sign of this market's turning potentially bullish is 6,844. But sort of a more definite sign of this market heading upwards would be a break to 7,429, which is just level up here. Until we break that level, I think we could remain choppy. Okay. Yes, so I got a question from Maurizio here. Do I expect further weakness in the DAX 30? Yes, I do anticipate further weakness. But it's not interesting to trade, unfortunately. It's not, actually, let me check what you asked. Yeah, DAX 30, yes. So it's not, unfortunately, that interesting to trade, to be honest. Why? Because this is a weak downward sort of pattern, and it's not like a solid, nice breakdown. So a few days ago, we had this ascending triangle pattern here. So we took out this level, and you break horizontal level like this, and this made perfect sense to sell here. Unfortunately, we were just up for a few days and then stopped out at entry. So that would have been good. But this pattern right now, I think it morphed into some sort of a wedge. And this is actually maybe an indication of things maybe ending at one point. The problem with these sort of patterns is that they're very difficult to trade. Rather, that ascending pattern was good. Earlier this year, you had this one, which I didn't trade. I should have traded it. So you had, this is the Hong Kong Stock Exchange. Remember when everybody's talking about China? People love to talk about China, like, oh, look, it's not going great, or oh, they're gonna crash their economy, but they never give you the trade ideas. They just give you the silly macroeconomic commentary. And the problem with macroeconomic commentary is that you can't even verify it most of the time. What's interesting here, though, is here you had a nice break. This would have been a very good setup to short. And it's usually these sort of ideas I'm looking for, and we don't have that in DAX right now. Okay, we're gonna wrap things up. I'm running a little bit behind schedule today. Guys, thanks so much for joining me, and don't forget to follow us on Twitter and on YouTube, and see you guys tomorrow, same time. Well, actually a little bit earlier, so probably 9-10 as always. Have a good day, guys, and thanks so much for watching. Bye-bye.